Quick question. Would you rather have 1 million cash today or a penny that doubles every day for 30 days?
Most people pick the million, seems obvious, right? Wrong. The penny becomes 5.3 million by day 30. That's the power of compound growth. And it's the exact principle most people ignore when they are picking stocks instead of buying index funds. In 2020, I opened a demo trading account on a stock simulator and ran an experiment with paper money. I thought I was a genius stock picker. I turned 5,000 fake dollars into 8,200 in 6 months. I was reading annual reports at breakfast and I had a watch list longer than my grocery list. Then 22 happened and I learned a very humble lesson about the difference between being smart and just being in a bull market.
Let me take you back. It's March 2020. The world is ending. The markets are crashing. And I'm sitting home thinking, this is my moment. Warren Buffett says, be greedy when others are fearful, right?
In a brokerage account and I bought 2 global diversified index funds. I set it and forget it. I also opened the paper trading account and I dumped in 5,000 fake dollars. Then I started buying what I thought were undervalued gems. Airlines, because people will fly again. Cruise lines, because boomers love cruises. And some random tech stocks Reddit told me about. And for a while, it worked. Everything went up. I felt like a market wizard. I'm testing my friend's stock picks. I'm considering starting trading with real money. I genuinely believed I had the gift. Then reality hit. The stocks I picked underperformed my index funds, the ones I had forgotten about. Some of my safe bets went sideways for 2 years, and I realized I'd spent hundreds of hours researching, analyzing and stressing, just to do worse than if I'd bought my boring index funds and gone to the beach.
But here's where it gets really interesting. Let me show you the most brutal comparison I've ever run. If you've been buying the latest iPhone every single year since 2007, the base model flagship, you've spent $14,583 on hardware alone. That's nearly 20 years of being loyal to Apple. But what if, and hear me out, what if instead of buying those phones, you'd invested that exact same money into an S&P 500 index fund? Your portfolio today would be worth $52,140. That's right, same money, zero stock picking skill required, just boring, passive index investing. Here's the kicker, the earliest investment do the heaviest lifting. That $499 you didn't spend on the first iPhone in 2007, that single investment alone would be worth over $4,000 today, an 8 times return. But wait, it gets worse. Here's the key.
What if you'd bought Apple shares instead of Apple phones? Your portfolio would be worth over $350,000. Apple stock has grown roughly 2,300% since the iPhone launched. You would have turned $14,583 into $250,000 just by investing in the company whose products you were already buying. Now, before you throw your phone out of the window, this is not me telling you to pick individual stocks like Apple, because here's the thing, picking the next Apple is nearly impossible. For every Apple there are 50 companies that looked just as promising and went to zero. Even if you'd correctly identified Apple as a winner in 2007, would you have had the stomach to hold through the 2008 crash when it dropped 60%? Be honest. That's why I only invest in index funds. For me, that's more than enough, and I didn't have to guess which company would win.
So here's the controversial truth that is going to make financial bros mad. Stock picking is a hobby, not an investment strategy.
I know that's harsh, but unless you are willing to treat investing like a full-time job, reading 10Ks, understanding balance sheets, tracking sector rotations, statistically you are going to lose to a simple tracker fund. And I'm not just talking about amateurs like us. Studies show that over 15 years, 90% of professional fund managers, people with Bloomberg terminals, analyst teams, and Ivy League MBAs underperform the S&P 500. And I know that is true because I got a notification from my brokerage in the UK saying that my portfolio's performance is in the top 5% in the last 5 years. And my academic background is on sports. So if the pros with all their resources can beat the market, what makes you think you can with the Robinhood app and the Market Watch subscription? The odds are so stacked against you that it's not worth the time, stress, and opportunity cost.
Remember that penny question from the start? Let me show you why compound growth is so powerful and why it's the secret weapon of index investing. Day 1, 1 penny. Day 10, £5 and 12 cents. Day 20, £5,242. Day 30, £5,368,709. The first 20 days look boring. You are sitting there with barely 5 grand thinking, I should have taken the million. But then exponential growth kicks in. And in the final 10 days, you go from £5,000 to over 5 million. This is exactly how long-term index investing works. The first decade feels slow, but by year 20, 30, 40, the compound returns are absolutely staggering. The S&P 500 averages about 10% annual returns. That doesn't sound sexy, but if you invest $10,000 today and just leave it for 30 years, it becomes $174,000. And if you add just $500 a month on top of the initial $10,000, you are looking at over $1 million after 30 years. That's the penny doubling in action. Boring, consistent, unstoppable. Let's kill some myths, because these are the lies keeping people stuck in the stock picking purgatory.
Myth 1. You just need to find the next Amazon or Apple early. Reality. Even if you identify a winner, you probably won't hold through the crashes. Amazon dropped 95 in the dot-com bust. Will you have held? Most people panic sell at the bottom. Myth 2. Index funds are boring and won't make you rich. Reality. As we just saw with the iPhone example, turning $14,582 into $52,140 with zero effort is pretty damn good. The S&P 500 has created more millionaires than stock picking ever will. Myth 3. Professional stock pickers have secret strategies. Reality. 90% of them lose to the index after fees. You are paying extra to get worse results. It's like upgrading to business class and still ending up in a middle seat. Myth 4. You can't time the market if you are smart. Reality. The best 10 days in the market often happen right after the worst 10 days. If you are out the market trying to time it, you miss the recovery. Time in the market beats timing the market.
Alright, enough theory. Here's the dead simple system I use that beats 95% of investing.
Step 1. Choose a low-cost tracker fund. You want fees under 0.2% and if possible hold it in a tax-free wrapper account like an ISA if you live in the UK. Don't overcomplicate it, just pick 1 or 2 global and diversified index funds or ETFs. Step 2. Automate your contributions. Set up automatically monthly investments. $100, $500, whatever you can afford. This is called dollar cost averaging. You buy high, you buy low, and over time it smooths out. If you'd invested the price of an iPhone annually since 2007, you'd have that $52,140 portfolio we talked about. Same principle. Dollar cost averaging is your crash insurance. Investing a fixed amount monthly means you automatically buy more shares when prices drop. Crashes become a sale, not a disaster.
Step 3. Ignore the noise. Markets will crash. Your portfolio will go red. Do not panic sell. Step 4. Reinvest dividends automatically. Free money compounding on free money. Don't leave returns on the table. Step 5. Check in annually, not daily. Rebalance once a year if needed. That's it. This is a 15-minute annual task, not a daily obsession. That's the system. 5 steps. You can set it up this afternoon and forget it about it for ages. The big mistakes I see constantly.
Mistake 1. Chasing hot stocks. This stock is up 200%. I should buy. You are buying high, that's backward. Mistake 2. FOMO on meme stocks. If your thesis is everyone on Reddit is buying, that's not investing, it's gambling. Mistake 3. Overconfidence after one win. You pick a stock, it goes up 30%. Suddenly you are a genius. Then you pick 3 more and 2 blow up. One lucky trade proves nothing. Mistake 4. Waiting to know enough. You'll never feel ready. Start with a simple index fund. Learn as you go. Mistake 5. Selling during crashes. Bear markets are when wealth is made. Selling turns temporary losses into permanent ones.
Look, if you genuinely love stock picking as a hobby, go for it. But do it with money you can afford to lose. And keep your serious wealth building in boring index funds.
The iPhone experiment proves it. $14,583 became $52,140 with zero skill, zero stress, zero research. Just consistent investing in a tracker fund. And remember that penny? Compound growth looks slow at first, but given enough time, it's absolutely unstoppable. I wasted 3 years with my experiment trying to beat the market. Don't make my mistake. Let me be upfront, I'm not here to sell you on ETFs. Honestly, I think they are already oversold. If everyone becomes a passive investor, the whole system eats itself. But here's the thing, for me personally, index funds just make sense. So make this for what it is, one person's perspective, not a manifesto. Now, with that out of the way, let's talk about what investing actually feels like. Even if you are just buying a boring global index fund, you are in for a ride. The stock market is like playing with a yo-yo on an escalator. The secret is to stop staring at the yo-yo. What matters is the escalator, where you are headed, not the dips and spikes along the way. Here's where most investors trip up. They confuse volatility with risk. They are not the same thing, not even close. When the market drops 20% and you panic sell, you haven't protected yourself. You've done something far worse. You've taken a temporary price swing and turned it into a permanent loss. Volatility can't hurt you if you don't let it. The moment you sell, though, it can. Think of it like flying from London to Zanzibar. Volatility is the turbulence. Bumpy, unsettling, maybe a little terrifying when the place suddenly drops 500 feet. But the plane is still flying, it's still going to Zanzibar. Risk is something else entirely. Risk is the plane going down. Risk is never reaching the destination. Turbulence is not a crash. Don't treat it like one. For long-term investors, volatility isn't a bug. It's the price of admission. Sit with that for a second. The discomfort you feel watching your portfolio dip. That's what buys you the upside. Risk, on the other hand, is the chance that the upside never comes. Yes, that's real. You could, in theory, lose everything. But here's the flip side. With consistency and discipline, there's no ceiling on the upside. 1000%, 5000% or more, losses have a floor. Gains don't. And perhaps the most underrated stat in all of investing. More money has been lost sitting on the sidelines than in every market crash combined. The yo-yo will keep doing its thing. Just don't forget you are on an escalator.
If this helped, subscribe, and comment. Are you team stock picking or team index funds? Let's debate. Next video, I'm talking about real estate versus stock market. Now, I could finish this video and check the news or my portfolio, but there is no need since I'm a passive investor. So I'm heading out to explore Skopje instead. Since I just arrived in Macedonia today, I'm choosing travel over screens. It looks lovely outside. See you next time. Bye.